Welcome to another deep dive into the world of finance. Today, we'll be exploring the thrilling topic of volatility in stocks and cryptocurrency. Now, you might be wondering, what exactly is volatility? Well, in the simplest terms, volatility is a measure of the frequency and severity of price movements in a market. Think of it like the heartbeat of the market. The faster and stronger it beats, the more volatile the market is. Understanding volatility is like having a compass in the wild west of investing. It's a key tool in managing risk and making informed investment decisions. Whether you're interested in traditional stocks or the exciting realm of cryptocurrency, getting a handle on volatility can be your secret weapon. As we dive into this topic, remember we are not financial advisors and this video is for informational purposes only. Always do your own research. Let's start with stocks. These traditional financial instruments have been around for centuries, and their volatility patterns are well studied. When we talk about volatility in the stock market, we're referring to the degree of variation in a stock's price over time. What exactly fuels this volatility? Well, several factors come into play. Let's delve into them, shall we? First up, we have economic indicators. These are statistics that tell us about the overall health of the economy. They include things like unemployment rates, inflation, and GDP growth. When these indicators show signs of trouble, investors might get nervous and decide to sell, causing stock prices to fluctuate. Next, we have company news. This can be anything from an earnings report to a new product launch or even a scandal. For example, let's consider a hypothetical tech giant. Let's call it Tech Titan. If Tech Titan releases a stellar earnings report showing higher than expected profits, this positive news could send the stock price soaring. Conversely, if Tech Titan is embroiled in a scandal, investors may lose confidence and start selling, causing the stock price to tumble. Lastly, let's not forget about market sentiment. This is the overall attitude of investors towards the market or a particular stock. It's often driven by news, trends, and the general mood of investors. If the sentiment is positive, it can drive stock prices up. If it's negative, it can drive them down. It's a bit like a popularity contest, isn't it? So, we see that stock volatility is a complex beast, influenced by a cocktail of economic indicators, company news, and market sentiment. It's a delicate dance, with each factor playing its part in the ebb and flow of stock prices. While stocks can certainly be volatile, they're often seen as a safer bet compared to the relatively new world of cryptocurrency. Yes, stock prices can swing wildly, but compared to the roller coaster ride of cryptocurrency, they're often seen as the more stable choice. But as always, it's essential to do your own research and not rely solely on trends or hearsay. Stay tuned as we delve into the volatility of cryptocurrency in the next segment. Now, let's turn our attention to cryptocurrency, a market known for its wild price swings. If there's one word that never fails to surface when discussing cryptocurrency, it's volatility. But what exactly fuels these abrupt price shifts? A few key factors contribute to the volatility of the cryptocurrency market, including regulatory news, technological advancements, and speculative trading. Let's begin with regulatory news. Cryptocurrencies operate in a relatively new and unregulated market. When news breaks about potential regulation or governmental intervention, it can send shockwaves through the crypto community. For instance, consider a time when Bitcoin's price dropped significantly in response to news of regulatory changes. Investors, unsure of how these changes might impact their holdings, may panic sell, driving prices down. Next, we have technological advancements. The crypto market is constantly evolving, with new cryptocurrencies and blockchain technologies emerging regularly. These advancements can influence the value of existing cryptocurrencies. For instance, if a new cryptocurrency offers superior technology, it might cause investors to shift their funds, impacting the price of other coins. Finally, let's talk about speculative trading. Many individuals are attracted to the crypto market due to the potential for high returns. However, this speculation can lead to pump and dump schemes, where the price of a cryptocurrency is artificially inflated, only to crash when those behind the scheme sell off their holdings. This speculative trading can cause significant price volatility. It's important to note that while these factors can lead to dramatic price fluctuations, they also contribute to the appeal of the cryptocurrency market for some investors. The potential for high returns can be enticing, but it's crucial to remember that the risk is equally high. The world of cryptocurrency is a roller coaster ride. One moment you're soaring towards the sky, and the next, you're plummeting back to earth. It's a market that demands resilience, patience, and a healthy dose of caution. Cryptocurrencies, with their extreme volatility, can offer high potential rewards but also come with substantial risk. So, how do the volatility levels of stocks and cryptocurrencies compare? Let's dive into it. When comparing volatility, it's important to look at similar periods for both stocks and cryptocurrencies. For instance, over the past decade, we've seen some major fluctuations in both markets. In the stock market, we've observed consistent growth punctuated by occasional dips and crashes. These fluctuations are often triggered by real-world events such as changes in political climate, economic instability, or even shifts in consumer behavior. However, the stock market has a long history of recovery, and these dips are usually followed by periods of steady growth. On the flip side, the cryptocurrency market, being relatively young, has demonstrated extreme volatility. It's not uncommon to see double-digit percentage changes in the value of cryptocurrencies over a single day. This volatility can be attributed to a variety of factors such as technological advancements, regulatory news, and market sentiment. For example, Bitcoin, the most widely recognized cryptocurrency, had an incredible bull run in 2017, reaching nearly $20,000 per coin. But in the following year, it lost over 80% of its value. Then in 2020, it started another meteoric rise, reaching new all-time highs. This kind of volatility is what makes cryptocurrencies both thrilling and nerve-wracking. The potential for high returns is there, but so is the potential for significant losses. So, why the difference in volatility? Well, stocks are tied to companies. Their value is influenced by factors like earnings reports, the overall health of the economy, and industry trends. These factors tend to change gradually over time, leading to relatively stable prices. Cryptocurrencies, on the other hand, aren't tied to any physical assets. Their value is largely based on speculation and market sentiment, which can fluctuate wildly in a short period. Plus, the cryptocurrency market is open 24/7, so trading never stops. There's also the factor of market size. The stock market is much larger than the cryptocurrency market. This means that a large purchase or sale can have a much bigger impact on the price of a cryptocurrency than it would on a stock. In sum, while the potential for high returns in cryptocurrency due to volatility can be alluring, it's important to remember that it also comes with a higher level of risk. Ultimately, the choice between investing in stocks or cryptocurrencies largely depends on an individual's risk tolerance and investment goals. Whether you are a conservative investor who prefers the slow and steady growth of stocks, or you're comfortable with the high-risk, high-reward nature of cryptocurrencies, it's essential to make informed decisions and always do your own research. The choice between investing in stocks or cryptocurrencies largely depends on an individual's risk tolerance and investment goals. Today, we've taken a close look at volatility in the worlds of stocks and cryptocurrency. We've journeyed through the terrain of traditional stock markets and the digital frontier of cryptocurrencies, unearthing the factors that cause their respective volatilities. In the world of stocks, we've seen how business performance, economic indicators, and market sentiment drive price fluctuations. We've also observed that while these fluctuations can be substantial, they're typically cushioned by the inherent stability of the physical assets and the economies they represent. On the other hand, the cryptocurrency universe, unhindered by physical assets or national borders, dances to a different beat. Its volatility is influenced by factors like technological changes, regulatory news, and market sentiment. We've noted how the absence of a central authority or underlying assets can lead to dramatic price swings. Comparing stocks and cryptocurrencies, we've discovered that while both can offer significant returns, they also come with their unique risks. Cryptocurrencies, with their higher volatility, can provide substantial gains in a short period, but also bring about steeper losses. Stocks, while generally less volatile, offer slower, steadier growth, the kind that has stood the test of time. An essential takeaway from our exploration is that understanding volatility is key to making informed investment decisions. It's about knowing your risk tolerance, diversifying your portfolio, and keeping a close eye on market trends and news. Remember, we're not financial advisors, but we do believe in the power of knowledge. The more informed you are, the better equipped you'll be to navigate the thrilling yet unpredictable financial seas. In conclusion, whether you choose to invest in stocks, cryptocurrencies, or both, understanding volatility can be your compass, guiding you towards your investment goals. Thanks for watching. Don't forget to like, comment, and subscribe. And hit the bell notifications so you'll get updates anytime we upload a new video.